Afternoon, people. We are going to get started in a minute or so. While we are waiting for folks to log on, let's get to know each other. And I can see attendees hopping in. Drop your business name, guys, and what you do in the chat box. I would love to see who all are there in our webinar today. Queen. Let me know if you guys are able to see. So let's start. Again, welcome today. Welcome you all today to the webinar We Eat the VC with Geri Kirilova from Laconia Capital, presented by Early Growth. My name is Kushbu. I'm an event marketing manager with Early Growth, and I'll be your host for today. A few housekeeping notes for you all. This webinar will last for approximately 60 minutes, including time for a Q&A at the end. You can place your questions in the Q&A panel at any time. This webinar will be recorded and sent to you all registrants within 48 hours of this presentation. You can also find this recording and all of our previous webinar recordings on our YouTube channel. The link to it will be sent to you in the recording email. Something about us. Before we get started, let me tell you something about Early Growth. At Early Growth, we have got the entire finance stack covered. What that means for you really is two things. First, you have got your strategic partner in growing your business. Our CFOs, with their years of experience and dozens of startups under their belts, help you see what's coming, good or bad, and take advantage of it. From strategic decisions to fundraising, they've seen it all before. Second, our CFOs, senior accountants, and tax advisors take care of all of the blockings and packings related to day-to-day, month-to-month, and year-to-year of your finances so that you can focus in your business. Both Early Growth and our CFOs have been around the block a few times. We have helped and served over 5,000 clients coast to coast and around the world, approximately 40 countries. As always, our CFOs have helped our clients raise billions of dollars. We'd love to help you and serve you as well. What we believe in delivering peace of mind by providing you all one-of-one solutions for all of your needs and requirements, including CFO services, HR, accounting, taxes, and insurance. We'd like to protect your profitability by giving you a sole point of contact to answer all kinds of questions, strategic dashboards to help you understand your business and company better. We want to be a partner in growth to help you bring your business grow and by working the back end and so that you can focus your growth side of your business. So we have a special promo running for you. It's not too early to start your planning your 2022 taxes. We want you to get your provider in place before the end of the year so that you can have an effective tax planning before the year ends. We have a promo running to help you with that now. You can get $500 off with your 2022 tax preparations. Okay, so kick us off, I want to do some quick poll questions to see who's in the room. So I'm going to start the poll and it will go all along the presentation until I end the webinar. And I'm going to start it now. I hope you guys are able to see the poll. You can fill it anytime you want to fill out all the questions and let us know your thoughts on the same. Okay. Something about our partners. So your team is critical to your success. And that's true whether you're building up a startup or putting together a great webinar. We have got a number of great partners in the startup community, but for today, events, it's the best of the best. Early growth has always been focused on the team, the community. We know together we go further. To bring you today's webinar, we have a startup team. To tell you more about our partners, we have our moderator with us, Stephen Austin. So Steve has joined Early Growth as a business development manager 6 months ago. And prior to joining Early Growth, Steve was a benefits specialist at Affleck and direct sales specialist at Shift Pixie. He has also worked in TriNet for over 2 years as a professional employer consultant. Steve enjoys hiking and exploring New York City and have recently taken up the photography as personal hobby. So before we proceed, just a reminder, if you have any questions for our VC, please put them in Q&A window, not in the chat. So here to introduce our partners to take over. I hand over this to Mr. Steve Austin.
Thank you very much for the introduction, Khushbu. Happy to everybody on the call. We have great participation, excited to have these keep going. We have an excellent team, as Khushbu said, a lot of representation in the Northeast, and we have a New York City dream team with us as well. So very excited, as I said, to have everybody here, and just wanted to introduce my partners as well. The first one being Erica Listrito of JustWorks, PEO. So Erica, if you don't mind introducing yourself and telling us a little bit about JustWorks.
Thanks, Stephen. Thanks, Khushbu. I'm super excited to be here today. Thank you for having me. I am a senior account executive at JustWorks. I've been with the company for about 4.5 years now. JustWorks, if you haven't heard of us, we are a professional employer organization. We've been in the space for about 10 years now. Essentially, we help small growing businesses anywhere from 2 employees all the way up to a few hundred employees get access to much richer health insurance benefits at lower cost than they can typically get on their own. We're able to pool all of our small businesses together to access large group health insurance, typically much richer plans, lower cost premiums, and more stable renewal increases. In addition to the health insurance side of things, we provide an all-in-one platform to help manage payroll, HR tools and support, and take on employer-related compliance. So everything from quarterly tax filings, workers' compensation, local, state, federal government regulations. JustWorks acts as the professional to protect small businesses from things that they may not be aware of. And so, we work with a lot of small companies that are hiring their first employees, or maybe they've been around the block and they need some better health insurance. Maybe they are fundraising and looking to scale and don't have a dedicated person to help manage their HR. So instead of sort of piecemealing all of these things, we bring it all into one platform. It's a very integrated, automated, modern system, and get them access to better benefits that allow them to sort of compete with these Fortune 500 companies that offer really great benefit packages. I'm happy to answer any questions. If anyone would like to know some more information, please feel free to reach out.
Appreciate it, Erica. JustWorks has a great model, and Erica's been a great partner for anybody on this call that's interested in any PEO or HR services. She'd be a great partner for you. The next person I want to introduce is Andrew Otto of Silicon Valley Bank.
Awesome. Thanks, Stephen. Thanks for having us here. Really appreciate it. My name is Andrew. I'm the managing director of SVB Startup Banking Practice here in New York. I'm a previous customer of SVB as well. So speaking from both experiences, SVB works with about 50% plus of all VC-backed companies out there on one half of the equation. And on the other half of the equation, we work with many of the VCs and private equity firms that finance these businesses. We work with founders from day one all the way up through IPO, worked with about 2/3 of those who IPO'd in the tech sector in recent years. But in the early journey, right, I love events like this because a big part of what we do is think about a founder's journey to that critical milestone of their Series A early on. So on the banking half of the equation, free banking solution for the first 3 years of your business, comes with all the bells and whistles, brand new platform, no minimum balance, 1% money market rate, and a credit card as well. And then on the other half of that equation, we have advisory. So I'm super excited about the team we're building here. We are all ex-founders, VCs, and operators on my team. I came from the VC world prior to this. And we do a variety of events like this and one-to-one advising and coaching to help founders get to the next step. So we have experts on financing and fundraising here. We have experts on go-to-market strategy, building out your product. And we love connecting with founders to discuss all the above as they begin their financial journey. So I'll drop a quick overview here if folks want to put kind of a visual to what we offer, but really appreciate you having us, Steve. And I'm here to learn more, right? I learn more from each of these and then hopefully get to kind of regurgitate that to the ecosystem. So thank you.
Of course, Silicon Valley has been a great partner and would be a great fit for a lot of companies on this call as well. So if anyone has any questions, reach out to Andrew and he'd be more than happy to help you out. And then lastly, we have our panel lead today, Geri Kirilova from Laconia Capital Management. Geri leads investment groups from software companies. She has extensive experience in software, technology, real estate, and other industries. Prior to joining Laconia, Ms. Kirilova worked in business associates at Techstars. Around 2014, she began her venture capital career. And Geri, as a New Yorker, has also studied at NYU Stern and also at Hunter. So very happy to have her aboard and learn more about Laconia Capital Management and get some great advice from her as well.
Thanks for having me. I just realized I'm the only one without a fancy background behind me. Laconia's branding is very minimalist if you're judging by this, but it's great to be here and thank you all for having me. You know, we bank with SVB, we work with JustWorks and early growth at either Laconia or through a portfolio company. So really excited to be here with you all.
Absolutely. And we're really excited to have you and learn about, just learn some of your knowledge and what you can help with. So I guess I'd like to start kind of just learning a little bit more about Laconia Capital Management and kind of what your mission is.
Yeah, happy to share. So for those of you who may or may not be familiar with Laconia, we're based in New York. We are a pre-seed and seed stage focused B2B software fund. So we're generally leading or co-leading rounds. Our sweet spot is rounds of 1 to 3 million, although we've gone smaller or bigger depending on what the company's capital needs are and how the round is shaping up. We're sector agnostic within that. So we have investments in fintech, marketing services, supply chain, really across the board. We're very opportunistic when it comes to the areas that we dig into based on the founders we meet and what we find really exciting at any given point in time. And we generally take a very concentrated approach to building our portfolio. So our first two funds, our first fund had 7 portfolio companies, which is a little bit reckless. Second fund has 10. We're currently investing out of our third fund, and that one will have about 20. But we really have strong alignment with founders in that approach. Venture capital has a little bit of a reputation of cutting bait on companies that aren't necessarily taking off like rocket ships from the very beginning. We, on the other hand, hang on for dear life and get into the mud and really try to make sure that a maximal number of our companies reaches a successful outcome of some sort. We are not good at cutting bait at all, for better or worse. So I would say that's maybe one of the things that's a little bit different about working with our team. And we all, every VC says this, so it hardly sounds unique, but we really love working with founders and helping them build the companies of their dreams. So we're a very small investment team. There's 4 of us full time. And we really are focused on capital strategy, sales acceleration, and operations in that sort of pre-seed, seed through Series A stage.
Very interesting. And I like that you're long-term, and I think anybody here would want somebody who's going to be long-term with them. So with that said, I would like to hear maybe a little bit more about if a company does become part of your funds, how does Laconia help them, and what can a company expect from you guys long-term in that time frame?
Yeah, that's a great question. So we don't have a large platform team, or a lot of service providers in-house, or a whole bunch of specialists who are really working with companies operationally. The view that we take is that we can serve as sort of the connective tissue between the founders and other vendors in the ecosystem who are specialists in terms of hiring or accounting, tax management, really whatever it might be. So from an operational perspective, we're actually not super involved day to day. What we do really focus on are the three elements that I mentioned: sales acceleration, operations, and capital strategy. On the sales acceleration side, we actually start kind of testing the waters on this working relationship as part of our due diligence process. So once we decide, I guess maybe it makes sense to take a step back here. So in our investment process, generally one of us on the investment team will meet a company. If we think that it's a fit for our investment strategy, we're excited about the opportunity, our next meeting will actually be a full investment team meeting with the founders, which is kind of flipped from the way I think most venture funds do it, where that full partners meeting is at the end. What we'll do is we'll all meet with the founders pretty early on, and then we'll kind of take an all hands on deck approach to that due diligence process. As part of that, one of the things that we'll do is we'll actually make a bunch of prospective customer introductions for the founders to get them in front of real potential customers. The benefit for us, of course, is that we get real market feedback without having to either bother or rely on the already bought in perspectives of people who are their existing customers. And then for the founders, it also generates some sales leads for them. It shows that we're willing to put in that work. And it basically gives them a sense of the industries that we have decent access into to be able to, jumpstart that initial customer base for them. So that's one of the key elements of that sales acceleration piece. We do that even pre-investment, and then it remains a key component of how we work with companies after we already write the check. The other elements of that are a little bit more tactical in nature. So two of our partners on the investment team both have sales and marketing backgrounds in particular. So there's a lot of operational expertise that they bring to the table, specifically around structuring sales compensation, managing a sales team, like really all of the nitty-gritty things of how you might want to actually implement some of these things at a very early stage, particularly because in many cases in the companies that we're investing in at this stage, if they've had any sales process to date, it's almost always entirely founder-led. And that's a very different experience from actually organizing and structuring a full team that's responsible for that function. So those are kind of the main things on the sales acceleration side. In terms of capital strategy, a lot of the discussions that we're having with founders are focused on key milestones and assumptions that they need to validate with a certain round of funding. So we are somewhat wary of the acceleration that we're seeing in markets where some companies are raising a lot of capital much faster than ever before at ballooning valuations. We encourage founders to be really mindful about staging their company's growth, setting a strong foundation first, and then also keeping in mind what their optionality is in terms of exits. So given that we invest very early stage, we are not a VC who would veto or be against an exit of, say, $100 or $200 million, which for a lot of larger funds generally focused on later stages, those outcomes don't really move the needle for them. And they have more incentive to really swing for the fences on larger outcomes. Totally makes sense for their fund model. For us, depending on the situation, depending on the company's growth trajectory and the market that they're in, those could be amazing outcomes for everyone involved. And we encourage companies to stay mindful of what those, benchmarks are in their given industry and make sure that they're not pricing themselves out of what would otherwise be very lucrative options, both for us and for them, and frankly, for their employees. So, we spend a lot of time thinking about what are those key milestones that you need to validate? At what point are you ready to take on additional capital? Who are the right kinds of investors and partners for that next round? And really using capital as a strategic lever, as opposed to, just raising one round after another because that's what the TechCrunch headlines suggest that you're supposed to be doing. And the last piece is really just the operations piece. As I mentioned, we're not really day-to-day tactically involved in this stuff. We can provide input because we have a bird's eye view across a large portfolio of companies and generally are seeing a lot of companies in the ecosystem. So we can do some sharing of best practices and things like that and connecting them to other founders or other vendors in the space who can help them out. But for the most part, that's the place where we're encouraging them to set up all of this infrastructure the right way for themselves to provide that strong foundation for growth.
Very interesting. It sounds like working with Laconia, you get a lot of structure, a lot of support, and then also some access that you might not have in general, which I think everybody here would say is extremely valuable. So another thing that I'm sure, of course, one thing that I'm sure a couple people like to hear is maybe about maybe some of your favorite success stories and maybe what they looked like throughout that path from start to finish, and how Laconia was able to guide them through that.
Yeah, that's a good question. I guess there's two that are kind of top of mind. So we had a company in the first fund called Promote IQ in the vendor marketing space. So they were selling to retailers to help them optimize effectively like the digital, like the sponsored products, digital ad spend on their website. So the same way that Amazon has a sponsored product category that brands can actually bid for those spots, they were providing a similar functionality to all other non-Amazon or e-commerce websites effectively. So like one of their biggest customers was Kroger's, which is, you know, one of the largest grocery chains in the US. That was a company that we led the seed round. It was a $2.5 million round, something like that. And the company had really strong growth, brought on this massive retailer very early on in the trajectory of the company's own life cycle, successfully serviced this client, and was navigating very long enterprise sales cycles. And one of the things that, I guess, I don't want to say this was a downside, but one of the things that was like specific to their business was that because they onboarded the customer so early on, they did have a fair amount of revenue concentration in terms of where the bulk of their revenue was coming from. And they got an offer, a buyout offer from Microsoft, maybe 2.5 years after we did that initial investment, at a multiple that would have just been, frankly, stupid to turn down. And given, you know, the competition in the market, there was a little bit of, you know, a competitive situation even with Microsoft and their own product offerings that they were trying to build out in the ad tech space to potentially compete with them. Given the revenue concentration, that was making fundraising a little bit challenging. That was a situation where, you know, we really sat around the table, talked to the founders extensively about this, ran the numbers, looked at the math, and we're like, look, this is going to be life-changing for the founders. It's going to be life-changing for many of the early employees as an outcome. And, you know, because we were pretty early on and we're managing relatively small pools of capital, the outcome for us was that it ended up, you know, returning the capital of our fund, which is a great outcome, pretty, you know, for one company to do that, let alone that early on in the life cycle. So that was a scenario that I think, you know, if you Google that outcome, you're not going to find an exit value on it. It is not, you know, a multi-billion-dollar headline deal that really makes the headlines, but it was such an all-around success story for everyone involved, that we, you know, we're really excited about being part of situations like that as well. As an aside, one of the early employees of that company was a former Laconia intern who recently rejoined our team full-time a couple months ago, after spending 3 or 4 years at the company and then 2 years at Microsoft. So there's, you know, I guess there's sort of a side note success story there in terms of the Laconia team's involvement and participation. So it's, you know, it's been a fun journey to be on in many ways. You know, on the flip side, I guess another example of that, or another example that's on a slightly different trajectory, we're investors in a fintech company called AutoFi, which, you know, just announced, I think it was an $85 million round at something like 700 million post-money valuation, you know, very much on sort of a unicorn growth trajectory. You know, that's a case where they've been able to accelerate growth. I think they're doing, you know, 3 or 4 years of consecutive 100% year-over-year growth. They've taken on a fair amount of strategic capital from financial institutions, as well as automotive companies. They're a financing solution for dealerships in the car buying process. But that's another example where, you know, I think the growth trajectory has been very staged. The revenue that they are generating is consistent with the valuation that they're raising at. You know, it makes us a little bit nervous as a shareholder, just based on any potential future, you know, revenue multiple contraction that we might see in the markets. But overall, you know, it's not a ridiculous type of situation where the company is pre-revenue or has a couple $100,000 in revenue and is raising hundreds of millions of dollars. And so I guess the common thread between both of those examples and why we would consider them very successful is because we feel that there is fundamental value being created by these businesses, and it is being done in a way that doesn't put the company or the founder's outcomes at risk at the expense of, or for the benefit of venture upside. So that alignment is really important to us, and we try to replicate that in pretty much any investment that we do.
Very interesting, and I'm sure that's very useful to a lot of businesses as well. Like you said, you have the opportunity to make early employees have a life-changing start. So I think that's that's incredible. I know you have a lot of experience with legal, fintech, and some supply chain. Is there anything that you're able to help with in those areas unique, or any trends that you see over the next couple of years that you might be able to help companies with?
Yeah. So thematically, we're focused on companies that are digitizing legacy markets and industries. And that does tend to push in the direction of industries like legal services, supply chain, financial services, as you can imagine. There's just so many opportunities there where processes are either still very manual or pen and paper or using, enterprise tech from 20 years ago. So there's a lot of opportunity there that we're looking at. I guess one interesting trend that we've seen, and I haven't looked at the data on this, so I don't know if this is like there's a universal rise in this or if it has just increased in our own deal flow. We're seeing a lot more almost like full stack, vertically integrated solutions, especially with a tech-enabled services component. So, it used to be that we wouldn't really look at anything unless it was pure SaaS or pure software. Now we're looking at lots of things that have more of a service element, whether it's in the healthcare space, or even in legal tech. We've looked at a couple of things, because just when you're selling into these legacy customer segments, in many cases they have different needs, and it's not necessarily going to be so much of an like a self-service product offering. They'll need some of that service element too. And so, we've been interested in opportunities like that, assuming that we can see the path to more scalability and high margins, and a kind of a venture scale outcome, even if it is a sort of a tech-enabled service model. So that's one thing, just seeing more of these like fully integrated solutions as opposed to, cobbling together fragmented things that are doing just a small piece of the overall workflow process. One of the elements of that we are seeing more and more is embedded fintech elements. So being able to process payments, in many cases offering bank accounts. There's been a huge boom in just that segment of the market over the last couple of years, with either banking in a box solutions that are making it really easy for any company to spin up financial service products, or generally just a lot of this kind of payments and embedded fintech infrastructure that's out there now. So that's something we're seeing more and more of too. One of the things that I think is exciting about that is that it opens up new revenue streams for a lot of these businesses, where they don't necessarily have to rely on just subscription revenue or services. They can also generate cash from any of these financial products that they're offering. So whether it's interchange or whatever it might be, if they're issuing bank cards or something like that. So that's another thing that we're interested in. And we're seeing a lot of innovation in that business model side and in the pricing of these products, which is cool. And the third area I would mention, which is actually somewhat different from that first category that I talked to on the enterprise side with the tech-enabled services, is we are looking at a lot of things that are in more long tail markets. So looking at technology that is focused on either small to medium sized businesses or mid-market customers, as opposed to large enterprises that would maybe be doing, multi-million-dollar deals. We're seeing a lot of opportunity in different industries in that long tail, because the barriers to building technology for these customer segments have decreased. There are more options for bringing sort of enterprise level or enterprise quality technology to these customers at a lower price point with an easier adoption curve. The challenge there, of course, is the go-to-market strategy and distribution, and how can you access these customer bases in sort of a scalable and a cost-efficient way. But it is exciting from a technology perspective to see that there's so many options now for companies and small businesses that otherwise would have been out of reach even 3 to 4 years ago.
A lot's definitely changed in the last few years. Obviously, COVID, although dying down, is still have a little bit of effects on businesses all over. But I was wondering, with technology changing so rapidly, what you've seen with COVID, kind of the positive and the negatives, and then what you've seen potentially with, maybe the metaverse and Web3 and kind of that expanding into the next few years.
Yeah, I mean, the last 2 years have been just on a human level brutal for the most part. It's been a stark reminder that the vast majority of us are in very privileged positions to be able to work from home and, for the most part, stay reasonably isolated from some of just the worst implications of this. From a work perspective, in terms of pros and cons and just general observations around that, the implications on talent and hiring have been a double-edged sword. Some of our companies have really been able to accelerate hiring because they can now bring people on anywhere. On the flip side, so can all of their competitors. So it's been a little bit of a manic process in terms of getting that hiring strategy in place. I think on the management side and the team morale side, it's been an interesting forcing function. I know a lot of people will say that, there's nothing like in person and you lose career development opportunities if you're not in the office and hanging out with your colleagues and all that. My hypothesis around that is that a lot of companies actually have a terrible company culture and path to professional development. It just doesn't feel that way because they feel good about all the in-person interaction, but it actually masks a lot of those problems. And so I think this remote only environment for a while actually forced companies to look at, well, how do we promote people? How do we train them? How do we get people up to speed? Who's getting these opportunities? Who's not? And so I'm optimistic that this will actually be a net positive to companies because it has forced them to put more structure and more thought into the ways that they are actually managing their teams and leading their companies. I hope we don't lose that as companies start trickling back to in-person and kind of defaulting back into old habits, because I think the status quo before COVID was not very good from a team management and professional development perspective universally. So that's my thinking on that. On the fundraising side, it's actually very interesting because I think it should be a net positive. I don't know if founders experience it this way, so I would love to hear from anyone in the audience who has gone through this on that side of things. I can speak to it on the fundraising perspective from raising our fund from LPs, but so much of the early conversations in fundraising, if you think of it as that top of funnel, those intro meetings where you're trying to gauge, is this a fit? Is this even relevant? Is there a match in strategy and scope? When I think about the fact that we used to do all those meetings in person, which meant one person was commuting and you would commute half an hour for this 45-minute meeting, then commute half an hour back. I think there's so much to be gained from just being able to do so much of that top of funnel faster and then saving those in-person interactions for either deeper diligence sessions or post-investment, syncs and strategy meetings and things like that. So I actually think, this has pushed the investor base, which probably wouldn't have adapted this as freely without such an event, it has actually pushed them to adopt the use of this remote technology and that workflow in their investment process. And that should be really good for founders. So curious to hear everyone else's thoughts, but I imagine that now founders can get through 30, 40, 50 of these fundraising meetings in 1 to 2 weeks and be able to generate a lot more momentum in that fundraising process and be able to close rounds faster. I would still encourage everyone to do their due diligence and make sure that they know who they are potentially going to be partnering with and that they're not doing these shotgun investments and ending up with shareholders and potentially board members who they hate for the next 5 years. So you still want to, be careful in that selection process, but in terms of just managing that process and that workflow, that should be a huge net positive in my view.
Very, very interesting. We're a little bit more than the halfway through point. I just wanted to throw out a few questions that we have right now that were kind of towards the topic that we were on. Let's see, let me go through for a second.
Yep.
How often does Laconia or any of the VCs in the space look at non-dilutive debt financing versus equity?
How often do we look at it? So we don't do any debt financing. All of our investments are equity investments. I mean, we'll do some convertible notes as like insider bridges or things like that in between financing, but our main funding structures are equity based. We're not opposed to them at all. I'm actually doing a similar session to this with the Calm Fund later this week, if any of you are familiar with them. So I'm actually pretty bullish on a lot of these more innovative models in the space, like Calm or Collab Capital, or for later stages, things like Pipe. I think it's always a good option for founders to have less costly sources of capital, given that equity is the most expensive capital that founders can raise. It's not in our investment mandate, but we would certainly be open to having our companies look at options like this. We also have, at least a couple of our portfolio companies that at the time when we invested, they raised some venture debt in parallel, and that has worked pretty well for them as well.
Very good. I'm seeing a couple of questions that are very common, kind of, I'll go into them with our original kind of line. So what are some of the things that you kind of look for when you're reviewing companies, maybe some metrics or tangibles that might be important?
Yeah, that is a great question. And this has changed a little bit for us over the last couple of years. So when we initially started out, we were focused on what we were calling late seed investing, which was like, I guess that's what we now call seed because there was no pre-seed. We don't have hard revenue metrics. We used to try to get, companies that had at least a couple of grand in monthly recurring revenue or 25 to 50K in monthly recurring revenue. Over time, I guess we've just realized that that's less important at the early stages because it really just depends what the business model is and what those sales processes and enterprise, customer deals might look like and all that. So we don't have any really hard cutoff metrics. We are ideally looking for some kind of validation of market demand. In many cases, the investments that we've done follow a similar pattern in that they start out with a very specific, often vertical focused solution that has broader applicability into other verticals, but has a very strong definition of that initial customer type and pain point. So that's really what we're trying to hone in on. We're trying to understand, is this a must-have and is this solving a really high pain point for a well-defined customer? The more we can get a sense of that, the better. We know that the product is going to change, the customer segmentation is going to change, but having that degree of specificity in that initial hypothesis is important to us. Aside from kind of the answer to those questions, right? Who's your customer? What's the pain point? We're also trying to evaluate how the founders have reached these conclusions. How do they form their hypotheses? What assumptions do they need to test? And are they taking a market-focused approach to that? So all else equal, meeting a founder who says, hey, we tested these channels, we spoke to this many customers, we had 500 customer research interviews over the span of 8 weeks, is much better for us in our decision-making than had this idea, spoke to 5 of my friends who work at banks and they said, this is interesting, we want to learn more. So we really try to hone in on that customer focus as a proxy for that market validation, because ultimately the founders are the ones who are going to know best. We're not the ones who know what the market needs. If we did, we would go start that company instead of investing in it. So we're trying to figure out, who are the founders who have really, really honed in on this. In terms of more detail, we did a series of blogs that go into a fair amount of depth on our investment process. what we invest in, how we conduct due diligence, how we work with founders. If those are helpful to anyone, they are public on our website. I just dropped the link in the chat. I think the most detailed ones are probably around our due diligence. So if that's of interest, feel free to check those out.
Awesome. I'm sure everybody appreciates that, and that'd be a great way to kind of get the best practices and best way to approach you. I know there's, obviously metrics and things that you look for, but how about things like banking, PEO, and other HR systems or professional services? How do you feel about companies putting those into place, and when is a proper time to do so?
For some of these things, it depends how quickly they're hiring. I mean, in some cases, we invest in companies that don't have a plan to really grow a headcount much beyond, maybe a dozen people. So it's less mission critical. I think at the point at which they are doubling or tripling headcount year over year, it can be really helpful. We will occasionally also recommend that companies bring on something like an outsourced HR consultant or a part-time head of HR or something like that to just make sure they have some of those processes in place. That is sometimes the same person who can also do things around like employee engagement and development, and that sometimes not, sometimes they're two different people. But before they really have the ability to bring on a head of people or a head of talent, it can be helpful to have some of those supplemental resources too as it relates to growing the team.
Awesome. So what I'm hearing is partners like JustWorks, Silicon Valley, and RDdriven are great partners to have before and when they come on with you as well. One last, I guess, the million-dollar question that everyone wants to know. What is the best way to get in touch with you or approach Laconia Capital Management? Is there any best practices in doing so? And are there any things that people should avoid?
Yeah, I just dropped in the chat the link to our company submission form as well as my email address. So maybe this is surprising, maybe it's not. We actually do read all of these. We do respond to the vast majority of them. Email is great. Twitter DMs and LinkedIn are not. Those are a black hole. Things get lost. But yeah, founders are more than welcome to reach out to us directly. This may or may not be true for other investors. I think the investor community is still pretty split on this. I would say maybe 10% of VC investors earnestly solicit and review cold inbound. The other 90% are still stuck in the 1980s and think that the smartest people are already directly connected to them. So for them, you have to probably play the warm intro game, which is finding someone who's already connected to them, having them forward on your information, create all this work for everyone involved for no good reason. But for Laconia, you can just reach out to us directly. If you don't hear back, shoot us another note. Sometimes things do kind of fall through the cracks, but we do earnestly try to get back to pretty much everyone who reaches out.
Excellent. I'm sure everyone appreciates that information. Now that we have about 15 minutes left, I kind of want to open up the floor to everybody out there to ask any questions they would like for either Geri or any of our other panelists, Andrew and Erica. I'll try to get through some of the questions from earlier, but if anyone wants to ask anything now, please feel free. And let's start with one of the closer ones. How do you assess the landscape for R&D-driven startups investments, productizable research? Sorry, didn't say that right.
I have to admit, I'm not sure what this means. The landscape for R&D driven startup investments. Yeah, I don't know how this is. I don't know if Fadi has the ability to clarify that question over audio or via chat, but if you can share a little bit more context in some way, I'll give that my best shot. I think directional, if I'm correct about where this is directionally going, we are generally very go-to-market focused investors. We are not investing in deep tech or frontier tech. We're generally not taking on a lot of pure technological risk. We're taking on market risk. That is just us, Laconia, as a firm. That's where our strength is. So if it's, in life sciences or biotech or something like that, it's generally outside what we would be investing in. If it's extremely technical to the extent to which we can't wrap our head around it, That's probably something we wouldn't be able to do at this stage. But if that doesn't answer the question, happy to give it another shot with a little bit more context.
Perfect. Do you prefer investing with startups in the NYC area, or are you national? That's from our friends in Chicago.
We are national, and actually our associate is from Chicago. She's in New York now, but we like Chicago a lot. We are mostly focused on the US and Canada. We are, I would say, somewhat valuation sensitive. So we're trying not to invest in post-YC companies in the Bay Area. We're really looking at markets that are to some degree underserved and really need capital. We would rather find diamonds in the rough wherever they may be than just kind of compete for allocation in hot deals. So yeah, happy to look anywhere in the US and Canada, and then opportunistically, even beyond that internationally as well. But our core focus is the US and Canada.
Great. Another question we have is, how often does Laconia or any of the VCs in the space look at non-dilutive debt financing versus equity?
Oh, I think we talked about that one.
I apologize.
Yeah. No worries.
What valuation caps are you comfortable with when investing in a seed?
Yeah, I think for Fund 2, which is now fully deployed in terms of initial investments, I think our average post money was around 12. And most rounds were about $3 to $4 million. So that's usually where we end up. Highest valuation we've done, I think, is just over 20. It ended up being a fairly large oversubscribed round. So just in terms of the amount of capital they were taking on, it didn't make sense to do it at a lower valuation given founder dilution, which is something that we're very sensitive to as well. But I would say our sweet spot, would be to end up doing a handful of deals that are, kind of pre-seed rounds, sub 2 million at sub $9 million valuations, a bunch of deals that are sort of like mid-sized seed rounds in that, $12 million ballpark. And then, a handful of post-seed or large seed rounds that are up to about 20. I think anything beyond 20 just wouldn't be ideal for us just based on our own portfolio construction.
Understood. Another question we had was, how would Laconia calculate the valuation for an early stage cybersecurity startups like ours?
Generally, we're trying to stick to those ranges. Of course, where exactly we end up is a function of the company's traction, what we perceive as the upside potential, what do we realistically think exits in the space are going to look like? And then, of course, just general demand. I don't know that we can really determine like a specific amount without having a concrete company and a concrete round in discussion, but the ranges that I just discussed are generally where we would want to end up as a rule of thumb.
Perfect. And then I think one last question I'm seeing right now is, can you talk more about your cooperative program?
Yeah. So we run a pretty large scale fellowship program. We just kicked off the second cohort for it. We have about 150 fellows and about 30 what we call venture operators. They're actually small check LPs in our fund who have operating backgrounds, usually former founders, former executives. And it's basically a structured curriculum that pulls back the curtain on our investment strategy and process. So it's 6 or 7 sessions that really go deep into how we approach all stages of the investment process. Also talks about fund management, so all the mechanics behind raising a fund, the back office administration, the different entities, and just all of the kind of nitty gritty, more mechanical things about running an institutional fund. Also talks about different pathways into investing, because our belief is that there are way more people who would be really capable investors, but there aren't that many traditional VC jobs out there because the industry is just job constrained. So the goal is for us to be able to effectively grow the startup market in terms of people who are investing in and supporting companies at the early stages, selfishly, so that we have more people who we can fund through our investment strategy. And then, of course, there are all sorts of benefits to us just in terms of people that we get introduced to. We've had founders who have gotten a lot of really helpful introductions from the fellows and things like that. So it's basically a supercharged community for us. We provide a lot of transparency, a lot of visibility, and we also offer upside to fellows who introduce us to a company that we end up investing in. So if a fellow sources a company, we let them shadow that whole investment process so that they can get the experience that they would get if they were part of our investment team. And then if we do the deal, we want this to be a mutually beneficial experience. So we will also compensate them with fund level upside. So that's a little bit about it. Thank you, Sam, for linking that blog. If anyone wants to learn more about it, there's a lot of information online. You can also ping me for more context.
Perfect. And then I think we just have one last question at the moment, which is, can you tell us a little bit more about your healthcare tech?
Healthcare tech. Yeah, oh my goodness, healthcare. It's just everywhere you look, there's like a multi-billion-dollar market. And what we've struggled with in healthcare is being able to, I guess, further segment those market opportunities, because everything seems like such a large opportunity, and figuring out what is kind of the most urgent problem to solve and what is the most broken about a given segment is not obvious at all. But we have two investments in the healthcare space. One is called Uvo Health. We actually just closed this round a couple months ago. They are working with federally qualified health centers, which generally serve either Medicaid patients or uninsured patients, but they're generally serving, in some degree, just the most vulnerable members of our communities. And they work with these federally qualified health centers to secure and execute on value-based care contracts. So they're effectively providing both a managed service and a contracting model that enables them to qualify for contracts they wouldn't otherwise qualify for, get more reimbursement from Medicaid programs for their services so that they can offer better care to their patient populations. So really talented team, depth of experience in both healthcare in general and federally qualified health centers in particular. I'm really excited about that one. And then the other one we have in the portfolio is called Noteworth. It's a virtual care platform that works with health systems on providing a more integrated patient, I guess, treatment experience. So they can do everything from telemedicine to post-surgical care coordination, to really just kind of bridge the gap between all the disparate data systems and make sure that the patient is getting a better end-to-end experience. So, it's a challenging space for us to navigate because there's just so many different sub-markets to it, but there's a huge need for new tech solutions there and for innovation. So we're excited to keep digging in there.
Very interesting. As we're coming to the end, I have one more question for you. Does Laconia look at equity crowdfunding as a negative?
We do not look at it as a negative. No, we're more than happy to have companies use it as initial customer validation, marketing, capital raising, all of it there. I guess my only caveat there, I actually don't think we've done any investments in companies that have done crowdfunding. We have seen some where it seems like the valuations are getting a bit above their skis from our perspective. So I can imagine that there may be a situation where by the time we look at a deal that's on a crowdfunding campaign, it may be valued beyond what we would be comfortable doing. Then again, that may very well just be an us problem and not necessarily a company problem. But that's just maybe my one flag there on what might be a little bit of a thorny or challenge for us with that. But otherwise, no, go for it.
Then we keep getting a couple more in. Do you put more emphasis on a company's revenue or on a product market fit?
Product market fit. but really more so, I think product market fit is like very hard to actually nail down and define in terms of what that looks like in terms of core metrics. We're really looking for a deep understanding of the customer segment, the customer pain point, validation of why this is solving that pain point, and understanding that revenue is important to the extent to which we believe that there is a feasible business model that will work here and that there will be a willingness to pay for the service, which can sometimes be an issue in companies that are targeting customers that may not have the budget within their organizations or are generally very price sensitive, or there's just not a lot of margin in the business and it can be hard to pay for additional tools. But at the pre-seed and seed stage, revenue is usually not the deal breaker for us.
Awesome, that's good to know. Well, I think that we're coming to the end of our meeting here, and I think it was extremely valuable in both knowledge and getting some best practices. I wanted to thank our partners again, Erica from JustWorks and also Andrew over at Silicon Valley Bank. I don't know if anyone has anything else left to say, but I want to throw my email in the bottom if anyone wanted to reach out directly. And Khushbu, I'm not sure if you wanted to end the call or if there's anything else that you wanted to leave with us.
Even if I may, I
Yeah,
wanted to
so-
add one thing.
Yeah, absolutely.
I'm so sorry. I totally forgot to mention this before, but if anyone is thinking about payroll, HR, benefits, when it's a good time to offer, and you guys are super early stage, we just started a program where we're offering female and minority founded businesses a pretty hefty credit on their admin fees in the first year, depending on when you were incorporated. So if that seems like it might be relevant for anyone, I'll leave that in the chat too, because it's a really great way to sort of get like your first year free on the platform while you're maybe raising funds, and still be able to get a system in place as you grow. So I'll put that in the chat too. But thank you.
That's awesome, and I'm sure it's going to be very helpful. Geri, thank you again for helping us out today.
Yeah, thank you for having me. Great questions from everyone. And if I can be helpful with anything else, feel free to just email me directly.
Thank you so much for your time, Geri. This wasn't such an intellectual session for every one of us. I have seen so much of interaction amongst audiences as well. Thank you so much, guys. Thank you so much, our esteemed audience. If you have loved our webinar, you may wish to see it again, you can hop on our YouTube channel, and please don't forget to like, share, and subscribe. So we have our upcoming Meet the VC coming in April 13th. It's gonna be with Forum Ventures, and we will be saying there, talking about all of the VCs and everything related to financial terms. So thank you so much, guys. With that note, I would love to thank you, each one of you, for being part of such an amazing webinar for today.
Thank you all.
Have a great
Thank you.
day.
Bye.